Welcome. I'm Joe Galvin, Chief Research Officer for Vistage, here to share the insights and analysis from the Q1 2026 Vistage CEO Confidence Index, which captured sentiment from over 1,300 CEOs over the first 2 weeks of March 2026. CEO Confidence Index sagged to 87.2, down 1.7 points from Q4 survey, stopping a three-quarter rise. The survey initially opened with a slight gain after the first day, but that was just 2 days after the bombing started. And as the war intensified and the survey ran its course, uncertainty reemerged to pull the index down. While it stayed above the 3-year average, it was a negative shift in economic sentiment that reflected growing uncertainty among CEOs. CEOs have become resilient to the turmoil of 2025, adapting to vacillating tariffs, stubborn inflation, and an anxious workforce. Entering 2026, CEOs were prepared for a solid year of growth with a more stable economy, but that was before the unanticipated war. While the implications are yet to be fully understood, CEOs once again are forced to face an uncertain future as the weight of war drags the index down. With that, I'd like to welcome Eric Post, Deputy Chief Economist from ITR Economics. Eric will be joining us each quarter to bring ITR's perspective and help us understand the economic landscape. He brings a profound ability to understand the underlying components to general trend analysis, contributing to some of ITR's most complex internal projects. Eric is a vital member of ITR's economics forecasting team. His ability to take detailed analysis and translate it into actionable steps for clients has ensured ITR provides trusted information relied upon to make decisions. And welcome, Eric. Thank you for joining us. You sure picked an interesting time to jump in and become part of this.
Oh my goodness, it's such an interesting time in the economy right now, but I'm thrilled to be here and really looking forward to sharing what data we have to the Vistage members.
So, Eric, let's start with the economy. The Vistage CEO Confidence Index dropped to 87.2 following the first 2 weeks of the war. How does that connect with your data, and what does that tell us about what's ahead for 2026?
Yeah, so when I zoom out and look at the broader movement in the Vistage Confidence Index and some of our other leading indicators, what we've seen is some upturn prior to this most recent tick down. And so we are on track for some mild growth in 2026, but we are seeing some signs of softening as we get deep into 2026, moving on into 2027. One of those we think may be the Vistage Confidence Index. We'll need a little bit more data to figure that out. But another one is our own ITR leading indicator, which has been moving down since a tentative November 2025 peak. And so all of those signals are signs that we're going to see some softening as we get late in the year and moving on into 2027. And business leaders should be thinking about if they're preparing for that now so that when that softness hits, they'll be ready.
So ITR has traditionally forecasted for a strong 2026, and you're saying this has now shifted into a more negative spin. How does that affect a longer term forecast for what we should expect for growth in 26 and on to 27?
Our 2026 expectation actually has not changed, but as we look at the very tail end of 2026, we've been expecting that slowing growth to take hold in industrial production, and GDP will certainly be in a slowing growth trend even a little bit sooner than that. But 2027 is that soft spot in the economy that we have been warning about. And so Vistage members just need to be prepared to endure that bit softer turn in the economy, and also really understand where they are in the economy, because one of the big trends we've seen is how different aspects of the economy are performing within the same overall picture.
Eric, let's dig a little deeper if we could. Inflation held steady at 2.4%. Now we're seeing the pressure, especially on energy prices. How is that going to change, and how should we plan for inflation as we go into this slowing growth and then into a flatter 27?
Yeah, so it is really interesting to think of what's going on in the pricing data from different components right now. And if you're looking actually at things like shelter costs, rents, for example, or housing prices, those are a little bit softer right now. If you're looking at services, maybe some tied to a little bit softer of a labor market, that inflationary pressure is easing. It's still inflation, but it's easing. But on the other side of that coin, when we're looking at food prices, when we're looking at energy prices, like you were mentioning, and especially goods prices, those are all on the rise. And so it's really important to understand which of those segments of the economy you're most tied to in terms of pricing, so that you can plan. So from an overall perspective, we're expecting the fourth quarter of 2026 to have 3.0% inflation relative to the fourth quarter of 2025. So not hyperinflation, and that's because some of those larger components, the housing component, the shelter component, the services components, won't be experiencing that rise, but we will see that upturn in energy, food, and goods.
To what degree have your models incorporated the rapid change with the closing of the Strait of Hormuz and that pressure on oil and natural gas and the whole energy sector? To what degree is that into your data now? And more importantly, when will it start to creep into your data and we can begin to understand how that's going to impact things going forward?
Yeah, we absolutely changed our oil prices forecast. There's no question about that. And what we did to forecast that is look back at what happened during other wartime conflicts. So we looked specifically at the Gulf War in the early 90s. We looked at the Russia-Ukraine invasion. And what we found is that we tend to see a pretty significant price spike and then a pretty significant price drop as the conflict resolves. And so when we forecast quarterly oil prices, which keep in mind monthly, and of course certainly daily oil prices will be even more volatile than this, what we're calling for is quarterly prices to be in the upper 90s here in late in the first quarter and into the second quarter. Starting tomorrow will be the second quarter. But then we'll see a pretty significant downturn later on in the year, and we think we'll be back to the 70s. Not quite where we were before, but pretty significantly lower than where we are today. But in terms of the impacts, it's really been fascinating to see where some things have been impacted and where some things have not. We're beginning to see some of those pricing trends trickle through to, like I was saying, food, energy, and goods pricing. But when you look at other things, haven't responded much. When you look at the weekly rotary rig count or weekly oil production, the U.S. oil industry is basically shrugging and doing the same analysis I would imagine we're doing and saying we need to see prices stay higher for longer before we're going to pump a bunch more oil.
Well, interest rates are another topic that frequently comes up. The Fed held them steady at the last meeting. We have this new pressure. What should we expect for interest rates as we look ahead?
Well, for short-term interest rates, there's two competing pressures here. The labor market is weakening. When you look at real personal income, excluding transfer receipts, that trend has flattened. So that is going to put some pressure on the Fed maybe to think about acting, but we have all those inflationary pressures we were just talking about pulling the other way. So we are doubtful that there will be any significant sorts of cuts. If there are, it's going to be a real deviation from normal Fed behavior. But regardless of what happens to those short-term cuts, we really want to make sure that the Vistage members are thinking about, are they more aligned with long-term interest rates or short-term interest rates? Because if you're looking at, for example, 30-year fixed mortgage rates, those are up at 6.38% for the most recent week, ended March 26th. So those long-term bond investors are looking out and saying we see a very inflationary world, not just with tariffs, not just with war, but limited supply of housing, limited supply of workers, limited supply of electricity, and they're saying we deserve to be compensated for that with higher interest rates. And so we're encouraging our clients and certainly Vistage members to think about what are some of those projects that they might need long-term money for that have a short-term payback, 3-4 years, save on labor costs, save on material costs. Those are the kind of CapEx projects that are going to move the needle in a positive way this year.
Thank you for that. We have to touch on employment. While over half of CEOs plan to expand their workforce in the year ahead, hiring is contingent on demand. What is your data on workforce expansion? And tell us where your thoughts are and where that's going in the labor market in general.
Yeah, labor market is fascinating right now because if you look at white collar employment, for example, you'll see layoffs creeping up, but wage gains are actually pretty healthy right now, a little over 4% for white collar workers. So white collar employment is not strong if you're a 22-year-old looking to get into that space, but if you're experienced, those folks are able to command those salary increases just fine. If you're looking on the blue collar side, also a similar wage increase of right around 4%, but very, very limited supply of workers and very, very high labor force participation rates among those prime age workers. And right now, we're seeing those wage gains run neck and neck with white collar. So the market has certainly shifted in terms of employment. But it is not an overall weak market. There's just pockets of weakness and pockets of strength overall. And so thinking about where your workers are, where maybe there might be some slack in the system, you might be able to take advantage of that and get some pretty good people if you're able to cross-train them this year in 2026 as the employment numbers slow a little bit here in the first half of the year.
Great. Our CEOs once again identified uncertainty as their top challenge. In Q1, and this was by a lot.
Yeah.
What does the ITR Uncertainty Index tell us, and why does that matter, and how should leaders think about that data?
Yeah, so the uncertainty index really spiked most markedly right after the imposition of tariffs early last year. And it's been on this general downward stretch, but still at a elevated level relative to where it was before. And so we're seeing businesses adapt and become accustomed to this more elevated level of uncertainty, but certainly the war doesn't help with that. We did see the economic policy index spike back up, not to where it was during tariffs though. And so we do see that uncertainty is generally dissipating as we look forward. That'll help us have some growth in the economy, but a lot of the growth is going to be nominal dollar growth fueled by inflation. And so we think it's really, really critical that businesses are out there looking at their cost structure, looking at their pricing, making sure they're pricing their products appropriately, and thinking about what are their volume needs and projections, and how does that relate to their labor force so they can be profitable through this period. It's a tricky period to manage, but if you manage it, and our biggest concern as a company is that firms will take the uncertainty to believe that they can't manage through it. You've got to be managing through it.
Eric, any final thoughts on what our data and the other indicators that you follow are telling leaders to do in the short term now, and then as we think longer term, looking ahead to 27?
Yeah, I think when I put it all together, what we're seeing is a situation where we're going to have very mild economic growth in terms of unit volume. It's going to be skewed toward a lot of things like big tech, for example. Some of the durable goods are going to have a better year in 2026. Some of the other industries aren't going to be on as good of a side of a coin as that. And so I think leaders really just have to understand how is their specific segment performing and make their plans around that going forward rather than getting swept up in what they're seeing in the headlines, because that's going to be changing every day here given all of this uncertainty that we have.
Well, Eric, thank you so much for your insights. I look forward to working with you throughout the year on future webcasts. Your guidance and analysis will help our leaders of small and mid-sized businesses better understand the dynamics of the 2026 economy. So thank you very much. Look forward to seeing you next quarter.
Thanks so much, Joe. I really enjoyed it.
Yeah, thank you. And for our attendees, please explore our full analysis of this quarter's survey, including the hiring landscape and how CEOs are governing AI in their organizations. Available at vistage.com/CEO Index. I am Joe Galvin, your Chief Research Officer, and this has been the Q1 2026 CEO Confidence Index webcast with ITR Economics. Thank you for watching.